Hey, good morning, options traders, and welcome back, everyone. Well, when markets get really volatile, like we've been in here recently, traders love to turn to credit spreads, and they feel like they have to do something to get money into their account. The fear kicks in, and they think, hey, if I go out and do credit spreads, I can get a bunch of cash into my account. And it sounds like a good idea if you just focus on that word credit. But what traders don't realize is where the credit is coming from. What's happening to earn that credit? So let's go find out. Where does that credit come from? And the answer will surprise you. As always, before we get started, please be sure to click like and subscribe. It's definitely going a long way into helping to promote the channel. Very much appreciated. So to understand where the credit is coming from in a number of types of trades where we have credit, such as short iron condors and credit spreads, we have to turn to the box spread. We've talked about the box spread before, so if you're not real familiar with it, there is another video in this forum talking specifically about a box spread. But remember that it is simply a synthetic long position combined with a synthetic short. And what happens is that it creates a guaranteed gain. So you can think of it as a T-bill, treasury bill. You're just going to pay a certain amount, and it's going to be guaranteed to mature to a higher value. So for example, you might buy the $100 call and sell the $100 put, and that is a synthetic long stock position. So if you don't understand your synthetics, there are a number of videos in here talking about synthetics. But if you've had the videos on synthetics, you'll know that buying a call, selling a put with the same strike, same expiration, is going to behave just like long shares of stock. It'll give you exactly the same risk profile. So we call that a synthetic long stock position. And therefore, the reverse is going to be true. If you buy, let's say, a 105 put and sell a 105 call, that's going to act like a synthetic short stock position. And so here's what these trades look like graphically. Here we've got kind of a mock layup of a broker's platform where we have calls across the top, puts across. Over on this side, we have our strikes down the center. We've got the longs on the left, shorts on the right. So if we buy the $100 call, put a +1 over there, that's our single long contract, and we sell one of the $100 puts, there's the synthetic long position. Down at the 105 strike, we are short the 105 call, and we are long the 105 put. And as I've talked about in previous videos, whenever you're learning this methodology for looking at synthetics, understand that we can do it visually just by looking at this distance. Do you see how that's a long distance between those? If you're to the outside edges of this T account, that's a synthetic long stock position. On the flip side, if we have a very short distance in here, that is a synthetic short. So it becomes a very easy way to visualize that. So up here is our synthetic long, there's our synthetic short, so think about it. If you are long stock at 100 and short stock at 105, well, that's a guaranteed $5. And that's really what this position, these four options are doing. They are synthetically allowing you to buy stock at 100 and being guaranteed to sell it at 105. Now, before you get too excited, go, hey, that's great, it's a free $5. Not so fast. The market's going to charge you for that. But here's what your resulting risk graph would look like. Here's the cost. Let's say you might have to pay $4.75. And it doesn't matter what happens to the stock's price. That price stays fixed once you pay the $4.75. And then at maturity, what happens? It becomes a guaranteed $5. So yes, you are guaranteed to receive 5, but after we account for the amount you pay for it, it might only be 25 cents. And so you're going to see that the amount that you pay will slowly rise towards this guaranteed amount over time. So once again, it acts just like a treasury bill. So the whole idea with synthetics and box positions is that it's a form of borrowing and lending. If you buy a box, or what we call the long box position, it trades at a discount. It's going to trade at something less than $5. So as I mentioned before, perhaps you pay $4.75 and receive $5. And so a long box is the equivalent of lending money to the market. You are spending money today. In other words, you're giving it to another trader, the person who is short the box, but you're going to receive more in the future. This is very much like a T-bill. If you buy a T-bill today, you are lending money to the government and receiving more in the future. On the other hand, if you short the box or you sell the box, you are borrowing money from the market. So there you might, let's say, receive $4.75 today, but owe $5 at expiration. In this way, it acts just like a loan. You might get a, let's say, a credit card charge of $475, maybe $475, and then you're going to owe $500. Something like that. You're going to receive less and owe more because you have sold the box. That's the equivalent of borrowing. So let's go back to our positions here. Let's take a look at a long vertical spread. Let's say that you are long the 100 call and you are short the 105. All right, so this is a debit spread. And this is the one that everybody wants to run from because they go, oh, a debit, I'd rather have a credit. Well, let's dig a little deeper and find out where that credit's coming from. Let's take a look at a synthetic short. So you know that that is going to be short the 100 call and long the 100 put. And if we pair that up with a synthetic long, it means we must be long the 105 call and short the 105 put. And so let's highlight the box spread right there. Those ones are the box spread. And now look what happens to these positions. These top two cancel and these bottom two cancel. And so when it's all over and done, in other words, the debit spread plus the box spread, we're just left with this. And what is this? That's a credit spread. Long the 100 put and short the 105 put is going to be a credit. So what this shows is that the credit spread is nothing but a debit spread plus a loan. So it's kind of strange when you hear traders talking about credit spreads as if they're getting something magical or it's just somehow it's creating money for nothing. Well, you are mathematically doing a debit spread, but you're just borrowing $5 on top of it. So take a look at what happens if the debit spread is trading for $3 in the market. I think at least a lot of you know that the corresponding put spread, the credit spread, should be selling for a credit of 2. And so yes, right off the bat it looks better. Who wants to pay 3 when the market's going to pay you 2? But see, that's not the full picture. Over here you're also borrowing 5 and therefore you owe 5. So if you get a credit of 2 and you owe 5, there's your debit of 3. And so it is exactly the same thing as the debit spread. And as I've shown before in previous videos, that even if you did this credit spread for 2, the broker's going to debit your account $3 because it is a liability spread. There's no asset in that equation. If you own the $100 put and you sold the 105, you've got the obligation to buy stock for 105. That's what this is doing for you right here. And you've got the right to sell it for 100. So if you buy it for 105 and you sell it for 100, that's all that can happen from this setup. That's a loss of $5. That's what that's coming from right there. And the market is paying you $2 for that. So the broker doesn't really care how much you can make. The broker is always going to guard against the maximum loss. And that's why the debit spread would be a debit of 3, and the credit spread for 2 would also result in a debit of 3. So for anybody out there who thinks, let me go do credit spreads because I've got to get some money into my account because I'm taking losses, it is only an illusion. Credit spreads are debit spreads, and that's because credit spreads are liabilities. Credit spreads are nothing but a debit spread with an attached loan equal to the difference in strikes. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Options A to Z's Facebook trading group, and you can find a link in the description below.